Here we have the Dexcom 2023 Investor Day deck. Dexcom addresses the core issue of hypoglycemia. Hypo-DE study randomized controlled trial of 158 adults. Dexcom CGM effectiveness for individuals with severe hypoglycemia or impaired awareness of hypoglycemia. 72% reduction in hypoglycemic events, 50% reduction in nighttime hypo events, reduced risk of severe hypo, reduced hypo-related distress. So it seems that the results are very tangible and very material. We'll be interested to understand how these studies are financed and how these studies are created. I think we have to take a look at some of the studies and the analysis. Problematic glycemia within the non-insulin type 2 population is a significant challenge in the US. The level 2 and level 3 hypopopulation is at least as large as the basal population in the US and covered by Medicaid. That is very good. We need to show that glucose control is the leading to broader cardiometabolic outcomes. People with type 2 diabetes are often dealing with multiple comorbidities. On average, these individuals are managing 4.1 comorbidities type 2 insulin using population, 3.2 for type 2 population not on insulin. Weight management is a significant concern for people with type 2 diabetes and the clinicians that treat them. 66% I struggle to lose or maintain weight. 49% I am concerned about weight gain upon starting to take insulin. This I know to be very true even within the vision care space with ophthalmology. For example, people with diabetes, they often develop diabetic retinopathy, requires frequent injections in the eye, and that is monitored for most of their life until improvement does tend to show, but it is a long-term issue that they have to live with. Dexcom CGM enable broader cardiometabolic outcomes. We are seeing the indicators of outcomes become beyond traditional blood glucose metrics. Okay, we have ADA 2023 300-person survey assessing impact of Dexcom CGM 8 months post-initiation. For basal population, we recently demonstrated there is a reduction in clinically significant reduction in A1C levels. It'd be good to understand what this level means. So that's a bit more reading for myself. Clinically significant weight loss, that is very good. Dexcom users experienced average weight loss of nearly 5% over 8 months period. Our growing scale is key to our long-term success. Innovative manufacturing platforms to enable broad-scale software infrastructure designed to create efficiencies, ability to leverage existing platforms for future design iterations. It would be good to know how they are manufacturing their devices right now. What kind of protection do they have in place for their designs? Is there any supply chain vulnerabilities? What is the risk of corporate espionage from national or sovereign parties like China? These are things that we need to look into and assess what kind of risks do exist for their devices and software. Expanding and diversifying our global manufacturing infrastructure. So this is the United States, scaling G7 production in San Diego and Mesa. Okay, that's good. So this is on within the United States, and then here we have announced newest manufacturing facility in Athenry, Galway. I think that is in Ireland, I believe. And then here, this is Malaysia, I believe, now producing commercial product in Malaysia. Okay, so we have some of these three locations. So they are producing in the US, they're also producing in Malaysia, and another in Ireland. Okay, so are these contract manufacturers? I would imagine so. So what is the risk of losing designs? How safe are these facilities? What kind of contracts do they have in place? Where are the devices being designed? I imagine it's mostly in the US. Let's confirm that and let's assess the supply chain risk. Efficiently expanding hardware scale to support growth and cost ambitions. So between 2017 to 2025, they're looking at nearly 20x. What does that number mean? Is that the revenue? Is that the number of units sold? Be good to understand this number or what this 20x really means. Enabling commercial and financial flexibility allow us to support years of strong demand, enables more aggressive expansion into international markets, create efficient platform to support portfolio strategy. So it'd be good to understand a bit more, what do they mean by commercial and financial flexibility? Is it that they have a operating line in place or some sort of line of credit with the banks or with some sort of creditor to allow them the flexibility to expand and contract on demand, or is it something else? Allow us to support years of strong demand. So what does that mean? What is the burn rate? What is the runway of their current balance sheets? Are they even burning money right now? That's something to look into. Enables more aggressive expansion into international markets. How are they doing that? Right? What is the flexibility that is allowing them to do that? Create efficient platform to support portfolio strategy. So I think there are 3 to 4 product or solutions that they're offering right now. What does their portfolio roadmap look like, and how does that going to complement their current portfolio in the coming years? Well positioned to meet the key costs and product initiatives. On track for our $10 sensor standard cost. Dexcom 1 to the G7 form factor in Q1 2024. So that's what it looks like. These are very small, very tiny. So it seems that they are trying to manage their cost in that $10 at that $10 mark. I imagine this is the cost of goods sold, not so much the cost for the consumer. That's what I'm understanding. But if it is for the consumer, I mean, that is a very attractive price, and it could make sense given that they might be going for the mass market strategy instead of only targeting a segment at a higher price point. New software infrastructure designed to provide additional scale efficiencies, simplified software infrastructure, single app platform. That's very good. Dexcom 1 on the same software infrastructure. We have to understand what Dexcom 1 is. Global app infrastructure across languages. Okay, easy to iterate. Good to understand why is that the case, right? Is it modular design or is it something else? I think we have to talk to different software developers to understand why is it, what makes it easy to iterate, and what does that imply for financials? What does that imply operationally? I think this is a good thing overall, but we have to understand, what are the exact operational implications of the way that they have developed the product and software. G7 updates since launch, streamlined account creation. Okay, silence all. Be good to understand what is the benefit of this, how this affect the livelihoods, or how does this affect the users of this product. This is a feature that people don't really care about, or this is actually an amazing feature that will help them in managing their diabetes. Commercial runway is unparalleled. Deliver outcomes for customers and health systems, continue to drive greater access and awareness globally, expand into new markets. Dexcom Warriors. Everything starts with the user. Our Warrior program provides a forum for our users' voices. 20,000 Warriors at the end of 2022. Okay, so it'd be good to understand what this is. I mean, are we actually talking about an online forum that people can log in and use, ask questions? We should, take a look and search online to see if something like this does exist or not. Okay, so after a very quick search online, it doesn't seem like there is an official Dexcom Warrior forum or online forum that people use to log in. However, there are dedicated threads, subforums, and even a Reddit for Dexcom, and from a very quick search online, the feedback, many posts online show people very happy about their products, very excited about their products. So it is worth a deeper dive to the user feedback. But from the initial opinions and initial feedback that I've seen online, it is a very positive experience that people are having with this product. Customer retention rates. So here's Dexcom and here's Libre. So I imagine Libre is another product that people use. So here, which generates high brand loyalty and retention. Dexcom retention rate is more than 20% higher after 12 months of comparable patient populations. It's actually very curious why they are using Libre in this case and not something else like Abbott, right? I mean, they use different comparisons in different charts and different sections of their deck. It would be probably better if they were more consistent in the comparisons. Perhaps Libre does not, or a single competitor does not provide the same, but it seems that they are picking and choosing different products to compare to, and potentially that might be going towards serving purpose of these charts, right? I imagine they are not better than every single product out there in every single category. They might be better than Libre in one aspect, they might be better than Abbott in another aspect. Not necessarily it is a bad thing, but just something to keep in mind as we are looking at these charts and how, as we are trying to interpret these charts and the way that they're trying to present this information. Dexcom is the most covered CGM with the lowest out-of-pocket cost in the US. Pharmacy comparative monthly out-of-pocket cost. Most common claim, $0, Libre $80 to $90. Majority of claims less than $20, and for Libre it is averaging $70. Okay, so this is showing that it is very affordable. At the same time, the customer retention rate is very high. Also good to understand who is this benefiting, right? So is this showing that Libre, people that are on Libre do fall off and stop using the product and switch to something else, or they stop altogether? Or is it that for Dexcom, people are more adherent to using the product, right? So I think we have to understand, what does that mean, and is that better for Dexcom as a whole, right? And if there is, determine if whether or not there is a consumable component of it, and if there is, then certainly Dexcom is the beneficiary of this higher retention rate. Our commercial model empowers our customers. We have established broad channel access to enable long-term growth and customer choice. enable a customer choice pharmacy, simple to prescribe, broad customer access, efficient service model, durable medical equipment, consolidated supply, history of service for people with diabetes. Okay, so it seems like this is not an over-the-counter product, at least from the way they're saying it right now, and it requires a prescription from a doctor of sorts for you to get this product. So if that is the case, I'd be interested to understand what is their marketing strategy, how are they getting this to market, how are they getting doctors to recommend this. Are they working with distributors? Are they working with groups, for example, like Cencora that we looked at previously, to get into distribution channels that are out there, right? So I think these are things that we have to take a closer look at. Evolving our commercial force to meet end market demand. The majority of Dexcom prescriptions are now written by primary care physicians. Okay, so this is family doctors, primary care physicians. So these are the main drivers in the revenue, it seems. So in 2018, that was only accounting for 30% of their sales, and now it is at 52%. So because you understand how are they getting this increase, what has done successfully in the past, is the growth, is the trajectory to growth the same for the next 4 or 5 years, or is that going to change? Are physicians, are doctors going on different platforms and we have to reach them in different ways, or is it still the old school physical smile and dial and meeting clinics in person to promote these products, right? So we have to understand, what does that distribution channel look like? Is that going to change in the coming years? And how do we keep this growth going? U.S. market leadership provides a near-term and long-term growth. Here we have the current CGM penetration. So for gestational diabetes, we have 0%. For type 1 is at 55%. Type 2 is at 40 to 45%. And then for the rest, it is at a lower amount, right? So let's take a closer look. So type 1, type 2, right? So we have the market size is quite a bit smaller, and for type 2 non-insulin, which is greater than 25 million, the market size, they're at less than 5%. So it seems that perhaps there is more competition in the type 2 here, just because the market is bigger. I imagine the bigger groups like Abbott and Medtronic perhaps are focused on this area, whereas they have a competitive advantage in the smaller markets here, right? This is really the smallest market out of all of the 6. So be good to understand why they chose type 1 and type 2 IIT, and how are they progressing, and what is their strategy to enter the other type 2 markets down here. There is reimbursement in place for more than 6 million people who are not yet on CGM, and that number is growing quickly. So are they saying that the total market size is increasing, or are they saying that the eligibility for their product within these markets is increasing? Maintaining leadership in automated insulin delivery, clinician most preferred. Call upon clinicians indicated a preference for Dexcom, citing greatest accuracy, differentiated predictive alerts and alarms, unparalleled history of outcomes. Okay, so be good to understand, where are these preferences or this feedback, where is that coming from, right? So I think, so here we have CGRO partners, HCP perspectives. I mean, who is commissioning this, right? How are we getting this feedback? Customer choice, Dexcom was the number 1 factor in customer choice of Tandem Control IQ or Omnipod 5. Dexcom outcomes data is clear for type 2 basal population. Okay, so let's just go back. Here we have basal. Okay, so right now they're talking about this market right here, the 3 million, where they only have 10% market share. Extending leadership into basal, Dexcom outcome clear for the type 2 basal population. Mobile study results, significant improvements in A1C levels, timing range, hypoglycemia, and hyperglycemia, driven by behavior changes, not changes to medication regimes. Outcomes demonstrate to continue for those staying on full-time use. 94% of participants wanted to continue to wear Dexcom CGM after the trial. Okay, so it seems like these are generating some really good results. Be good to understand, why is the behavioral changes happening? Is it because of better monitoring? Is it because of better technology? Be good to understand, why that is the case. Outcomes demonstrated to continue use for those staying full-time use, right? So I think what they're saying here is that for those that did not continue to stay on full-time use, the results were not as good. So I think we have to understand, what percentage of the trial, what percentage of the population in this study and participants did stay on trial, how difficult it is to stay on trial, and ultimately that would indicate success, right? I mean, if only 10% did stay on course on full-time usage, we have to figure out, why is this so little, and how do we prevent that, and how do we make that percentage be higher? In recognition of these outcomes, coverage is building quickly. June 2021, mobile RCT publishing JAMA. December 2021, updated ADA standards of care. Okay, so now we're in 2023. We have CMS LCD finalized. 3 large PBMs now covering basal-only customers, following CMS, Dexcom has already achieved 60% commercial coverage for all basal population. Okay, so we have to understand what that means. So is it that those with basal diabetes today, are they eligible for commercial coverage, right? I think that's probably what it means. So are they saying that out of the 3 million that have type 2 basal diabetes, does that mean 1.8 million is eligible for Dexcom products, right? Dexcom has the right product and approach for the non-insulin type 2 hypo population. Dexcom is the clear leader in hypoglycemia prediction and prevention. CMS has predicted actionable criteria for this population to access CGM. We need to drive awareness. US summary, leading customer experience, most cover CGM at and lowest out-of-pocket cost, expanded and effective commercial infrastructure, unparalleled growth and opportunity. We are early in our international opportunity, expanding access globally, meeting the needs of each market with the right portfolio, moving into new geographies. Be good to know what level of market penetration is left for the US, right? Is it for type 1 and type 2 where they have the 40-50% market penetration? Is that where they are going after international markets, and at the same time they are continuing to pursue the domestic market for those where they have a lower penetration, or are they going after international markets all at the same time, right? I mean, if that is the case, we have to evaluate what sort of runway do they have, what sort of budget, what sort of resources, how easy are they having access to capital markets, what is their cost of capital, what is their debt. So we have to see if they have the arsenal for that international expansion. The right portfolio approach to unlock new geographies and expand more. Okay, so here we have the product series that we talked about, the G series, Dexcom 1, and I think here's the online portal as well. So here we have Germany, Japan, Canada, United States, Spain, Italy. So be good to understand, why are these countries being listed here? Is it that they have partnerships underway? They have discussions with the regulatory bodies underway for them to deploy and commercialize this product, right? So we need to look into that, and what is stopping them from, listing any Asian markets, right? I mean, China for one, Japan, South Korea, Philippines. I think these are all countries that could use something like this given the high rates of diabetes in those countries. Extending our commercial reach internationally, building greater direct presence. Since 2020, we have moved from distribution to direct in 8 countries, including Australia, Netherlands, Belgium, France, Slovenia, New Zealand, Spain, Luxembourg. We will continue to access opportunities and go direct in strategic market. So I think we have to understand, why are they going direct? Is it cheaper that way? Or is it that they want more control of their supply chain? I think we saw in the other slide that, or we saw in the other deck with Cencora, they're seeing more and more smaller and mid-sized biotech, biopharma companies using distributors. Why is it that they're moving away from distribution to direct, right? What is the long-term and short-term implications of this strategy, right? We have to take a closer look at that. Forming strategic partnerships. We have extended our partnership with Roche into Argentina, benefiting from their established commercial footprints. Argentina marks Dexcom's entrance into Latin America. We are growing fast and taking share internationally. Access wins, product portfolio, and flexible commercial infrastructure position us for continued growth, gaining international share. So we have Medtronic diabetes. Okay, so here is the organic growth rates. The rates are coming down. I mean, that does make sense as they are increasing in size. We have been consistently outgrowing our main competitors in recent quarters. International will continue to grow as percentage of total revenue. So in 2020, we have 20%, and 2025, we're at about 30%. What is next? Extending our growth runway into non-insulin using people with type 2 diabetes. Total addressable market. There is another over 25 million people in the US with type 2 that have not yet progressed into insulin therapy and are not at high risk of hypoglycemia. We see an opportunity to address this health crisis earlier to slow or even reverse the progression of diabetes. That would be very interesting if they are able to reverse the progression of diabetes. We are taking a multifaceted approach to reach this sizable population, leveraging digital health partnerships, pursuing reimbursed access, building software to create customized experiences. Common characteristics for this population: challenge maintaining consistency in diet and exercise, fear of long-term complications, roughly 80% receiving care through primary care physician, fear of progressing to medications, desire to feel normal, more likely to make own CGM decision. I think we have to understand how is it that what is the value add that they bring to the type 2 diabetes who are not on insulin, and what other roadblocks, whether if it's financially, mentally, or anything else that this population has from using a CGM, right? So from the looks of it, it is a semi-invasive device where it is plugged into your bloodstream. So I think for those that have not really seen the issues potentially of diabetes, they may not have the urgency to subscribe to such a device until it is too late, potentially, right? So I think we have to understand what are the mental, psychological, and physical barriers for them to opt to such a device and how those concerns can be addressed. 2024, Dexcom's first product designed for people not on insulin. Okay, so here we have an app. So this is a preview of it, and a unique glucose sensing solution designed for people who are not on insulin. Custom software, what does that mean, right? How does that affect the day-to-day life of these individuals? Cash pay option, 15-day wear period, launching 2024 to cover that market. So that is how I am understanding this. Dexcom has a track record of efficient growth, total revenue 32% CAGR. So it went from $720 million in 2017 to about $3 billion. So that is very impressive. Non-GAAP operating margin. So we went from -5 or -6% to about 16.7%. That is very impressive. So I think what that really indicates is that the overhead in staffing or research and development or other costs is very high. But once they've gone over a certain milestone or threshold, it is very much pure profit in that sense. And then we have free cash flow. We have a 64% CAGR, 2x the rate of revenue. That is also very impressive. So I think, again, this falls in line with the high overhead that I'm assuming they're having. So we'll have to take a look at their actual financials and see what their cost structure looks like, how consistent it is, if that has fluctuated, or if their operating expenses have fluctuated to a great amount as their revenue have increased. So we'll take a look at that as the next step. Enabled by embracing challenges to the status quo, several key examples demonstrate ways we have welcomed change into position our business to scale channel optimization. Curious to understand what that means. So if they're moving away from distribution partners, how are they going direct to the consumers? Global business service infrastructure. Okay, be good to understand what that means. Manufacturing and process automation, designed to value enhancements, direct international operations. Good to understand a bit more about all of these points and how they are executing and how that is benefiting them, and what is it that they're doing that the competitors cannot. Increasing our 2025 revenue range. Previously in 2020, they were at 4 to 4.5 billion. Updated, they are at 4.6 to 5.1 billion. Okay, so I think what they're saying here is that their forecast in 2020 was this amount, but now they are forecasting 2025 to be this amount, which is not a very big delta, right? I mean, they are actually very close to what they initially projected, so which indicates that they are responsible, they are making fairly real estimates. So this is a really good indication in how they are forecasting numbers even in this document here. Considerations: upside driven by strong demand performance or strong performance in the core US business and international market share gains. On track for goals of 700 million contribution from new markets in 2025. The 700 million, is that revenue or is that cash flow? It's likely revenue, but I think we have to get more clarity on that. Upside driven by strong performance, so it's really from the US international. Okay, so that makes sense. 2025 gross margin target on track. This is actually very, very accurate. They made a 65% projection in 2020. Now they are exactly at 65%. Expanding manufacturing with automated G7 lines, on track for $10 standard cost. Okay, that's good. Greater G7 volume, including Dexcom 1 to G7 form factor in Q1 2024. G sensor duration to 15 days, beginning with non-insulin product in 2024. Increasing our 2025 operating and EBITDA margin targets. We have 20% forecasted, and now they're at 21%. It seems that this is very consistent. They are making very conservative targets. Or flip side, it could be said that they are managing their financials to be in line with their forecasts, giving them more credibility as they make forecasts into the future. So I think we can take it both ways, but we cannot argue with the fact that their revenue is increasing, their margin is increasing, or their profitability is increasing. So we can't really argue with that. It is good. Operations, operating expenses, leverage is enabling balance of margin progression and funding long-term growth opportunities. Okay. Current business model resulting in significant cash flow generation. Operational efficiency is a growth driver. Collective responsibility for scalable business functions innovate everywhere. Flexible go-to-market strategies that product offerings that drive health outcomes, maximum growth, and global customer impact. How to execute Dexcom strategy for operational excellence. Our leaders work together to ensure that all functions support scalable efforts aligned to our long-term strategic ambitions. Manufacture total cost manufacture product, including material procurement. Develop total R&D and UX costs associated with product So they are looking to increase efficiency in all of these aspects, okay? Be good to understand a bit more on how that is being executed. Cost to manufacture examples. 15-day waiter, fully automated, high throughput line, optimize regional manufacturing, qualifying new suppliers, and sourcing and outsourcing. Okay, so be curious to understand what the risks in using new suppliers are, what happens to the old ones, are the designs fragmented in the sense that are they manufacturing parts, at different places and assembling at one centralized location, right? Because that will reduce the risk. So we have to understand what does that supply chain look like for this company. Cost to support, leverage global business services infrastructure, RPA, and AI to automate repetitious factors, facilities, and IT re-evaluation, efficient org design. Dexcom Global Business Service Units. Okay, we have one in Lithuania, Philippines. So this was not mentioned in their manufacturing geography. So they have offices here. So we understand why is it in Lithuania and why is it in Philippines and Manila and Cebu. GBS employees now make up to over 15% of our total employee base. Okay, so they are growing their international base, potentially lowering the cost basis of their payroll, which also introduces other risks such as supply chain, political exposure as well. So that does complicate potentially the operational risk of the company. Question is, do they have the funding? Do they have the sophistication? Do they have the infrastructure to withstand those risks? Or is this too early, right? Or even at 15%, this might be a really good entry point given the size they are into those countries. Our capital deployment strategy and value creation opportunities, positioning the business to maximize organic growth and customer impact, capital deployment priorities, establish global manufacturing capacity, expect a downstep in CapEx beyond 2023 as Malaysia scales. That is interesting. We have to understand why that is, what is driving that. Opportunistic M&A, opportunistic share buy, dilution reduction, understand what is it that they're buying, right? They are more or less a pure play. It seems that they have a product, they have they have a playbook already. So what is it that they're buying? Is it buying personnel? Is it buying in market share? Is it buying entry into a certain geography? We have to understand what that means. Fund organic growth, excluding or including expansion of international commercial infrastructure, optimal capital structure, flexible to access capital markets at low cash cost. We have to understand how are they doing that, especially given today's capital market conditions. How are they accessing the capital markets? Is it through debt? Is it through bonds? Is it through equity or equity issuances? If that's the case, it's not necessarily cheap given the equity premiums that we're looking at today. Maintain significant liquidity positions to capitalize on opportunities to enhance growth. Efficient tax structure. International expansion presents opportunity to create value through tax structure efficiencies. Expect global tax structures to enable reduction of corporate non-GAAP tax rate from high 20% to low 20% over time, with reductions starting in 2024. This, alongside with their international expansion and setting up manufacturing facilities, indicates that they are in a transitory position where they're thinking about setting the foundation for a global scalable business. They're expecting to increase their business in size significantly. They're putting on foundation from manufacturing, from operational, and from a financial perspective to sustain that growth. But I think this is what we're taking, this is what it's saying at face value. We have to understand how they are executing on that and how successful they are on it. So we have to keep a close eye on how that is going. We are executing a compelling plan for value creation, top tier organic growth, operating leverage to maximize our customer impact, significant free cash flow generation and growth. So it seems that they are doing financially well with the free cash flow generation, increasing global presence to enable efficient tax structure, capital structure position to enable flexibility. So they've mentioned this many times now, at least 3 times, I believe. It'll be good to understand how are they defining flexibility? Are they assuming they have that access, and do they in fact have that access to the liquidity, to the capital that they need to do what they're looking to do? Building market access faster than any time in history, basal coverage, public and private. So I think that's a new market they're trying to get into. Problematic hypoglycemia, international expansion, so entry to Latin America. So I think this is fairly recent. So let's pay close attention to articles, to news releases that they have on Latin America. Expanding product portfolio to serve new markets, J-series leadership, Dexcom 1 to G7 form factor, new non-insulin products. That is a bigger, as we've seen, a much bigger market. Updating our 2025 LRP with upside, increasing revenue target, increasing operating and EBITDA margin targets. What is next? Broader type 2, other analytes, gestational. So this, as we saw earlier on, this is a much smaller market than other type 2 markets. Be curious to understand why are they going after this market compared to others. Advanced algorithms, longer wear times, hospital pre-diabetes. This is a big one, and this is actually a very big one in other markets as well, right? Especially with Asian populations, African populations, to my understanding, they have a higher occurrence, a higher likelihood of contracting or developing diabetes. So it'll be interesting to see what their strategy is going into those markets. Software innovation, I think this might be a focus that other companies may not be doing as well, is that the device, with a lot of medical devices, these legacy companies, they have potentially some very good devices, but the UX UI of the software component, how to integrate with other products like Apple Watch or other smartwatches, are not up to par to some of the newer companies. So if they have a very good software, a very good user experience, and they have a decent product from a hardware perspective, this will definitely attract larger user base or potential customer base for their product over others. So I think this is it for this deck. So I think as a next step, we need to understand what their valuations look like, what kind of multiples are they trading at from a sales perspective, from a P ratio perspective. How does it compare to the market? How does it compare to comparables like Abbott, if that is comparable at all? We have to understand how are they executing on the strategies that we've talked about, such as into Latin America. How are the manufacturing facilities being implemented? And take a look at some articles or reviews on their products. This is actually a very simple company to analyze in some ways, because it's, there's not many products, there's not many services, and it's very consumer facing, so we can actually evaluate how well they're doing to a very highly correlated degree by looking at the most recent reviews, right? If we take a search and scrape online the recent reviews on Reddit on different diabetes forums and how well it's doing, looking at the issues, that would be a very easy indication on how the company, or projection even, on how well the company will be performing in the next quarter or two. So let's take a look at some of the financials very quickly. So here's the stock price of Dexcom. You see here starting 2022. So they have stagnated, much like every other company or many other companies out there with the interest rate rises. And given in healthcare, they are a lot less sensitive compared to consumer discretionaries or technology companies to the interest rate. But nonetheless, it is reacting to the interest rate, and we'll be curious to see what happens in the coming quarters to the share price performance. Right, and let's take a look at some of the valuation multiples. Okay, so at a high level, so we are looking at this company, and it seems that they are taking on some very technology-like multiples, where the PE is 100x or 63x for the next 12 months. Book value is 16 times. So there's not a lot that we can take from this. And let's take a look at income statement. So they are growing at a very rapid pace. The margins are actually decreasing significantly, right? So this is what we need to look at, right? Because of the changes in working capital, stock-based compensation, the cash flow from operations is actually increasing, right? In the first 2020 and 2021, it has stagnated a bit, and in 2022, that has increased. And let's see where that is coming from. So for net income, so stock-based compensation, there was a lot in 2020, and then there was a lot of change in accounts receivables. That means there's a lot more sales increase, right? If there's a sales increase and they're collecting on credit, there's an increase in accounts receivables. That means there's a reduction here. So that's where that's coming from. Okay, so that's a good sign. And then let's take a look at cash flow from investing, right? So this is a very constant. Okay, so let's take a look at cash flow from investing. So here we have a pretty constant reinvestment into the company. I would imagine this is for facility development or R&D. And then we have, so here we have some changes in investment securities. So it looks like they didn't do too well in 2020, as with most people. And I'm not sure if that was a forced sale or not, but that's a pretty big hit. But it's also discretionary, right? So it seems that there's not a lot of forced investment other than the capital expenditures, which is about 50-60%, if not 80% of their total cash flow from operations, which is on the heavier side, but it's not something that they cannot afford. And then looking at the financing activities, it seems that there was a repayment or issuance of debt, a bit of repayment of debt as well, some issuance of stock, repurchase of stock, right? That is interesting. That indicates if they're buying back their stock, often that indicates either they don't have a better use of the capital, or they feel that their stock price is undervalued, or a combination of the both. So we have to also take into account what is their cash balance when they did that. But from the looks of it, it seems that yes, they do have access to capital markets even during COVID. Here's to understand what that cost of capital is for that $1.1 billion overall. So here's the free cash flow. They're generating about 200 or 50 million to about $300 million in free cash flow. So looking at the current balance sheet, so we have about $600 million in short-term investments. So a total of about $2.5 billion in current assets, cash or liquid investments, that is good. Receivables, that is increasing year over year in proportion to the sales, so that is a good sign as well. And then let's take a look at the debt outstanding, right? So here we have current assets, okay, so 1.8, 1.9, that's actually a pretty big increase. Where is that coming from? Okay, so this is the current portion of the debt. Okay, so that's coming from the long-term liabilities. Total liabilities, we have about 1.1 and current assets 1.9. So this is not too bad. I think what might happen, if that's current, if they have a current liability of about 700 million and they have only about 600 million in a bank, they may potentially go and access the capital markets again to pay off that loan potentially, right? If they need that capital for operations reinvestment. So there is that small possibility. I mean, they do have enough, but that ultimately will be a strategic and financial decision that they have to make internally. And then we have long-term leases. So we only have common stock, no paid-in capital, no preferred equity, at least from what we're seeing here. And then let's take a look at our solvency ratios. Okay, so the debt to equity is on the higher side compared to other healthcare companies, but their EBITDA and EBITDA after capex compared to their interest expense is very good. So overall, I think they are in a very good market. The fact that they are a pure play allows them to focus on what they're doing and what they're good at.